A very good afternoon. You're watching the newsroom right here on ET Now. I'm Ajay Sharma. The markets are still maintaining bulk of the morning gains, though they're off highs. We also have to look at it from the point that yesterday too was a net a very good day, and the kind of nature of the market it has become last couple of months. It's quite uncertain. So if you are in a profitable position, might as well take some profit. So good amount of gains and expansions are followed by some profit taking bout which is happening right now. But we are kind of Nifty is above the 15,600 level comfortably, same proportion banks. Viral Virawala is joining us now, partner at Buoyant Capital. Viral, afternoon. So, are you getting the same feeling the way I am that despite all commodity prices coming down meaningfully from the top, in fact, agri prices are also down, veggies are down, and finally crude started cracking. But market is behaving very hesitantly towards all this.
Sure. So good afternoon, Ajay. The way I think what's happening is that the LME London Metal Index is down 21% over the last 3 months. And in fact, a lot of commodities are at 52 weeks low, and the metals index itself is flat or a little bit lower for 12 months. So clearly, all the industrial metals are trading lower. So the inflation print, probably what this means is that we have the worst of inflation print behind us, and from here we should sort of start seeing it slowly going down until at least October November timeframe, and then we should see a steep correction. Now, because of Fed's aggressive stance on inflation, many other central banks have also, trying to raise rates fast so that they sort of defend their currencies, and also, they are taking an aggressive stand on rates. But what this might trigger is a hard landing, and you might, push the economy into recession. That is probably, keeping the markets under check. And otherwise, this is a lot of good news that all the commodity prices are going down, not only the hard commodity but even soft commodities. But just as an example, wheat prices in the US are down 25% just in a month. So it's not only the industrial companies which will benefit, but also the consumer-facing companies which will benefit. But I think the bet is now moving on to, do we get into a recession or not? Markets seem to be tilting towards that. We'll probably get into a recession.
So, Viral, you mean to say that inflation is becoming less of the concern for the market now, but a recession or big slowdown or the kind of sledgehammer approach which central banks are taking on growth to tame inflation, that actually is becoming a bigger worry for the market, isn't it?
Yes, that's right. So that is what people seem to be thinking. So while India is in a sweet spot, but India is not decoupled from the rest of the world, right? We have seen India has already absorbed 3 lakh crores of selling in the secondary market, but this cannot go on infinitely. Even at today's valuations, FI own between 50 to 55 trillion worth of Indian equities, like 50 lakh crores to 55 lakh crores. So if sort of that sort of selling is going to come, and if globally countries are getting into recession, then India would be no different, and that is leading to the sort of market movement that we are seeing. But if you couple that with valuations are lower than averages. In fact, 2 years forward, so on FY24 basis, Nifty is just 15 and a half times. It's actually lower than its average, a little bit towards half standard deviation, and small cap is less than 12 times forward. So while earning might get cut a little bit, downgrade tend to take time, but still, valuations are sort of become compelling.
Okay, so let's talk about this valuation argument a little more. On the one hand, we are seeing that the benchmark indices valuations have come down to closer to the long-term averages. Mid cap, small cap have also come down in the same proportion. Now people are saying this slowdown could lead to scaling back of the earning estimates further. Is that a valid justification? Because if further downgraded earnings happen over and above what has already happened, then the scope for further valuation compression perhaps will also increase.
Let's take it in two bits, right? So one, yes, can earning downgrade at the index level happen? That can happen, will likely happen, but the quality of earnings will change. See, a lot of this Nifty movement, the Nifty EPS movement, was driven by a few metals and mining stocks and a couple of those large banks. So that drove that. Whereas the high P stocks, the FMCG, the consumers facing stocks, even pharma for that matter, don't really participate in the earnings upmove that has happened. The earning downward also will likely be more on the metals mining side, the low PE sort of stocks, right? So that's where even if earning downgrade ever to happen at a Nifty EPS level, market shouldn't go down a lot because what will happen is it's sort of value transfer from metals mining to consumer facing. So from a low PE to a high PE. So while at the index level the earnings might go down, at a market level markets might still sustain.
Fair point. That's a very smart point. Actually, you said the value transfer will happen, downgrades of commodities, and perhaps upgrades of commodity users. So, on an aggregate level, not much downgrade. Right. What are your kind of likings in this market? In this correction, which are the areas you added positions and have built your portfolio incrementally?
Sure. So, couple, I'll answer it in two ways. So, one, we have started to increase weight towards small caps. We run a multi-cap strategy, and we've gradually started increasing weight towards small caps. Because mid caps are still in between. In fact, the mid cap index is slightly expensive than the Nifty index. It's very counterintuitive. Small caps, there's a lot of value. A lot of small cap companies is where capex is completed, and now you will actually gradually see the revenue or the top line go up and profits will follow. So that is one sort of bucket or theme we are chasing, where capex is done and over next 2 years we'll see sustained growth because we have capacity. Second, if you look at sectors, the preference is for India versus global driven sectors. So what would be domestic driven would be financials, insurance, CV space. CVs have not done well for last 3-4 years or even 5 years, and that's sort of coming back. So and even building materials or engineering. So whatever is more prone to India is the space we like, and that's where we are deploying incremental funds.
Okay. Viral, give us a flavor of how's domestic money coming into the market, because you guys interact with your HNI clientele across the country. Is there willingness to kind of allocate more money into the market, because that has been the strongest pillar of strength, domestic markets. And now that market is kind of people, a lot of people getting impatient. If that flow or tap dries up for any reason, FI selling is not stopping. That could also be a big risk to the market, no?
Sure. So, historically, something that a lot of our domestic guys have worked with is that if 1 year market returns are negative, that's when domestic flows start slowing or falling. That's generally held true for many years in the past. Another thing that works is that if the term deposit or FD rates for mid-term deposits are in the 7% range, then sort of the domestic investor starts gravitating towards fixed income security rather than equity. This time that doesn't seem to be holding true. So we most of the alternative asset managers, AIFs and PMSs continue to see reasonably strong flows, and it is not only old money, which is called top-ups in our industry. So it is not only existing clients who are wanting to put in more money, but also a lot of new to alternative asset investors are coming. So a lot of the incremental flow is from new to that, new to this sort of category. And this somehow has not stopped. So in fact, after January correction, after a 2 to 3 month lag, one would assume that the flows would stop. But at least in the alternative asset space, whoever we talk to, that is not sort of, there's been a reduction here and there, but incrementally what we hear is there's still a reasonable amount of money on the sidelines.
Well, one of the DGs of RBI Michael Patra in the MPC meeting just 2 days back, MPC minutes coming in, they said that they expect inflation to fall to 4% by 24 and under 6% or around 6% by the last quarter of 23. And these guys have an eye on all the incremental high frequency data points. If you give them benefit of doubt that even if their forecast is 80-90% accurate, when do you think market will really meaningfully start factoring in the control in inflation?
Sure. So firstly, we need to understand how inflation works. Right? Inflation is an index. So what is very high in April 2022 or May 2022? So let's say the inflation index was at 100 and it's at 115 in May 22. So by 4%, you are still meaning that it will be at 120 in May 23 to get there. So, I mean, right now it looks difficult, but it is eminently possible that with where the metal prices are and if the conflict sort of resolves, and because of the sort of hard landing, inflation might come down. So inflation would gradually start sometime around October onwards. Inflation trends would look very good because of the base effect and tend to keep going down. The issue is not a little different in our view. The issue is about a hard landing. Normally, you are able to control inflation. So when does inflation happen, right? 11 out of the last 12 rate hike cycles were Fed. Markets have done well. Why is this time different? This time it is different because it's not a demand-driven inflation, but because of supply constraints. Right? In every, either in metals mining, mined commodities, as well as even soft commodities or even manufactured commodities like semiconductors. Now, bringing down that sort of inflation, you can only do that by suppressing demand. And on a low base, if you suppress demand more, that would tend to get into recession. So, if markets sort of come to a view that it's not going to be a recession, it's not going to be a longish period of low or no growth, and maybe it's one or two bad quarters and things will come back, that's the point of time we should see markets recovering.
All right, Viral, thanks very much for joining us on the show today. We must catch up one of these days over coffee. It's been long. Let's
Sure.
take a short break on that note. When we are back, we'll put the spotlight on a lot of stock specific stories which are rising. More analysis when we come back.